I would say if you're going to buy mining stocks, then try and get certificates. Try and actually be direct ownership of certificates rather than relying on a counterparty in the middle who legally are owners, if you like. You've got to protect yourself from that as well. It's not just a question of saying, well, I think this is cheap, so I'm going to buy it for whatever reason. No, you've got to look at the system and see whether the system is going to default on you as well.
Welcome back to the show. And joining us today is returning guest Alasdair Macleod, whose work you can find on Substack, where he covers sound money, economics, geopolitics, and everything pertaining to gold and silver. He's also an advisor at Von Greyer's. And Alasdair, great to see you again. How you been?
I've been fine. It's nice to see you again. Thanks for having me back.
Hey, likewise. I always enjoy our conversations, both on the camera and off. And I was just looking at events and news across the pond to see what's going on, and very interesting. With Starmer and the whole debacle there with Epstein and all that stuff going on. But I know we're here first and foremost to talk about the financial markets and what's going on that you feel is most pertinent. And so I figured I'd hand the mic off to you if you can kind of situate us with your latest thoughts on things.
Yeah, we've got, I don't know, it's a sort of gathering disaster, I think. When I look at the situation in America, I mean, you had retail figures which came out today being Tuesday, the 10th, I think. And of course, what happens is gut reaction in the market, mark down bond yields, in other words, mark up bond prices, because guess what? The betting now is there will probably be 3 Fed cuts in 2026. This is a load of rubbish. It really is. Because what gold has signaled and is still signaling is that the purchasing power of the dollar is going down. It's not gold being in a bull market. It's actually the dollar being in a bear market in terms of its purchasing power. That's the key thing to understand. Now, with that in prospect, if the Fed is going to cut rates, it's going to be in defiance of soaring consumer price inflation as the dollar buys less, if you like, during the course of 2026. So the market, I think, has got this entirely wrong. There's a lot of sort of hopium in the whole thing. Of course, there's also a bubble in tech stocks and so on. And you just need to look at the amount of margin debt reported by FINRA. On top of that, I mean, that's running now at 1.2 trillion. That's up from around about 250 billion at the time of the great financial crisis. As well as that, of course, the big players like hedge funds and so on, when they leverage up their positions, they don't go to FINRA, they go to the banks. So, the FINRA numbers are just the tip of a credit iceberg, which has inflated stock values. Now, the point about rising bond yields, when it happens, the bond yields will rise for the simple reason that when inflation starts rising, initially it's commodities, then it's producer prices, and then it's consumer prices. When that starts feeding through, bond yields are going to start rising out along the yield curve. And already, equities are very expensive relative to bonds on any measure. In fact, what I do is I put together a chart which compares the two, and you can see that from a normal trend where the two, if you like, are in complete antithesis in terms of, bond yields down, equities up. They follow a track which is absolutely fine, but it's now got so distorted. The distortion in terms of overvaluation of the S&P index relative to the 10-year or the 30-year bond is higher than it has ever been in recorded history. And that probably includes the 1929, September 1929. I mean, this is very, very serious stuff. So if you get rising bond yields, you see the 10-year moving up towards 4.75%, looking like it's going to go to 5%, then there's going to be a stock market crash. I mean, it's baked in the cake. It is as simple as that. And then what happened? Well, we know that the Fed and the US Treasury believe that stock prices are extremely important in terms of maintaining confidence in the economy. And if they see that crashing, they're going to be in there, rescuing the banks, rescuing this, rescuing that, trying to support stock prices. How do they do it? QE, massive QE. Does it matter that the dollar goes down? Well, of course it does, but it's not the main priority. The main priority is to rescue the whole financial system and stop it, resulting in an imploding economy. So it's a question of priorities. So rather than standing back, I mean, this would have been the situation, let us say, before the 1929 to 1932 experience, which was the first time that governments really started intervening. I mean, the answer was to stand back before then and let the economy sort itself out, because governments knew that if they intervened, then they would just screw it up. This changed under President Hoover and then, of course, under Roosevelt. But, we don't have the option nowadays to just stand back and let everybody sort themselves out. The sort of Schumpeter thing about creative destruction, if you like. We can't do that. We don't have the political mandate. So what do we got to do? We can't stand back and protect the dollar. We have to go in there and devalue the dollar. I mean, everything goes bust. You can either do it by defaulting or by devaluing. And that's basically what's going to happen, devalue. And bear in mind that direct investments by foreigners in the US dollar and through the US dollar in treasuries, bank deposits, and equities, which is around about, on the last measure that I saw, I think it was $22 trillion of that. Half of that 44 trillion is in equities. What do the foreigners do when that starts falling down? Well, they get the hell out of it. They won't rescue their 22 trillion. They'll probably only crawl out with something like 5 to 6 or 7 of it. But that's because, as quickly as they try and get out, I mean, that market's going to collapse. So that's, I think, the slightly alarming prospect, if you like, for 2026 in particular. And I just see that, the fall in the purchasing power of the dollar is something that is beginning to accelerate. It's already beginning to accelerate, reflected in the gold price. I think that will be proved in the coming quarter or two to have been, if you like, a prescient assessment by gold, not that gold has got a soul, but also going on from there, the collapse in the purchasing power of the dollar, I mean, it's beginning to look like the Reichsmark back in between 1920 and 1923. I'm sorry to say it, but that's the way it's going.
That is very alarming, and that's a very interesting history of what happened there. And you're making me think of other countries too that have experienced something similar to that. What are perhaps some other things that you are observing, and perhaps things even geopolitically that we hear a lot about that may come into fruition? Yeah, and having that.
Yeah, I think that, I mean, the geopolitical thing, which is fascinating, is China. I know that China has accumulated an awful lot of gold, which is off balance sheet, as it were. And I've been rereading the original regulations of 1983, appointing the People's Bank of China as the government's sole agent for managing the state's gold and silver reserves, acquisition and dealing. And there's no doubt about it that there is a lot of gold in China, in the state, which is spread around various accounts. Article 4 describes how that can happen. And if you go on from there, there's a different mechanism for them to accumulate huge amounts of silver. We don't know how much silver, we don't know how much gold. My guess is that the state by 2022 accumulated something in the region of 20,000 tons. They will have accumulated a similar additional sum since then, in my view. Now, I've got no firm evidence of this whatsoever, but this is just working it out, circumstantial evidence, if you like. When it comes to silver, well, all you need know is that, rather like gold, I mean, China rapidly invested in gold mines, so the result was that for the last 15, 20 years, she's been the largest gold miner by output in the world. But this is a small part of what she's been doing. She's also been importing doré from elsewhere, refining it and hanging on to it. And we know how she's absolutely drained Western vaults of their gold. The same is true of silver. The way she worked silver was somewhat differently. She's now the second largest silver miner in the world. She's been importing silver doré and refining that. I mean, even Mexicans' silver doré has been going over there. And on top of that, she's been refining non-ferrous ores, which contain silver. And something like 60% of the world's silver, remember, comes from, as a byproduct of refining non-ferrous ores. So she's been doing that too. She's accumulated a huge, huge quantity of silver, the amounts of which we just don't know. But this has been a policy that she's been doing while suppressing the price until literally, I suppose, around about September last year. At that stage, you had the sort of the spat with America over rare earths. And silver, as a critical mineral, was also part of that policy. Not directly, but indirectly. I mean, what followed the rare earths, clampdown on rare earths exports, was obviously a licensing situation which applied from the beginning of this year, which gives the state greater control over how much silver actually goes out to the West. So we have a situation where we've got a market crisis now in silver because silver is a much needed industrial metal as well as a metal which is attracting investment interest. And so consequently, people are turning to derivatives, trying to turn those derivatives into physical metal. And of course, the mountain of derivatives is infinitely larger than the amount of silver available. So the idea that, if, let us say, you've sold short in the forward market or on COMEX, and, you're going to be in a position where you're forced to deliver, where the hell do you get the silver from? This is the problem. And this is why you've got the hiatus in Western capital markets. I think that what China is now doing is she's actually holding on to silver. She's got a gold. She's also done two other things which are very, very interesting in this last week. The first of which is she's turned around to Chinese institutions and said, sell your US Treasuries. I mean, she hasn't made it as direct as that, but it's basically what she said. So where's she doing that? I mean, the excuse was she was worried about volatility of the value of US Treasuries. But US Treasuries have been traveling along with diminishing volatility. So that's just an excuse. I think it's part of a plan, basically, to, if you like, kick the dollar. We know that she wants the dollar out, but there's been a big change in her approach to the whole thing. In the past, she's just said, the dollar's demise is not, okay, we don't want to use it, but its problems are not ours. And we're not going to do anything to undermine the value of the dollar. That's been the perception, if you like, that she's got across. She's now getting aggressive on this, turning around and saying, sell your US Treasuries to her investing institutions is definitely a break with this softly approach. The other thing that's interesting is she's clearing the decks on cryptocurrencies. She's just announced regulations, laws, whatever, to penalize anyone who tries to trade in cryptocurrencies. There will be no cryptocurrencies in China at all. So why is this? I think she's clearing the decks for a dollar which is going to collapse. And what she doesn't want to do is have her own people suffer unnecessarily for it. She will secure the value of the yuan, certainly internationally, through moves which she brought about in the second half of last year, opening a vault in Hong Kong, opening a vault in Saudi Arabia, making gold exchangeable for yuan, and she will fix a rate at some stage. I wouldn't mind betting that that rate will be fixed for international trade settlement purposes. So it'll be like a sort of Chinese version of Bretton Woods Mark II, if you like. What she does with the domestic economy, I don't know, but I'm sort of theorizing hugely here. The last metallic standard which China had was actually a silver standard up until 1935. Now, this means that the domestic users of yuan are familiar with silver as backing for the currency. Now, she's got enough gold and enough silver to ensure that a ratio between the two will stick. So that way she could actually secure the domestic yuan against silver. Now, the reason I think this is likely is that I just detect with central banks as a whole, and I'm sure this is the case with the People's Bank of China, a huge reluctance to part with any gold to the great unwashed public. So, the idea of, let's say, the post-Napoleonic War standard, gold standard in the UK, where you could exchange £1 for one sovereign at the user's option, at your option. I think we're a long way from that. And I think that the first cut on this is going to be, we want to try and do this at an institutional level because we can control things a lot more rather than do it on a public level. So I think the public will probably have their domestic yuan secured by silver. Now, as I say, I'm theorizing here completely. I've got absolutely no evidence that this is going to be the case. But given that there is no evidence that this is likely to be the case, you have to ask yourself why it is that they've had this policy of accumulating huge amounts of silver. And this was before, sort of photovoltaic panels and before electric vehicles and all the rest of it, before, the main industrial uses today, if you like, before they really took off. I think that it would make some sense for them to go down that route. My preference, if I was advising the Chinese, would be to put in a proper gold standard. But I think the point, Christian, is that we are obviously not too far away from the destruction of the dollar. It's a lot closer than we actually might have thought, let's say, even months ago. And China is moving to protect herself. How she quite does it, we'll see. But she's given enough indications through her actions so far for us to be able to guess pretty much how she will protect her currency. And she's also signaling through her actions that she's having to get a move on because she thinks that the dollar is going to collapse quite quickly. It may be because she watches the price of gold. I don't know. But you can see that, things are hotting up. They really are. So 2026 is going to be, I think, a very difficult year for those trying to protect their wealth. I mean, it's very, very difficult. I know the answer, but I can't get anyone really, well, I mean, apart from a few gold bugs, I can't really get anyone to go with me. Anyway, that's where we are.
Wow. Yeah, there are a myriad of different things to track, and all you hear about more and more, I know, it's become very cliche, which is just the further, I guess, stratification of society and so on and so forth. And you hear a lot about AI and displacement going on, and would love to. I mean, could you share perhaps other things that you are tracking? I guess just to get more granular as it relates to indicators that say, okay, that let you know, okay, the puck is going to likely go this way, that way. I mean, obviously you gave kind of a high level overview of that, which is appreciated.
Well, yeah, I mean, basically the high level is that equities are doomed. Bonds will be doomed as well, because you're going to collapse the purchasing power of the dollar. Then, yields on the 30-year long bond, I mean, that's not going to stop at 10%, not going to stop at 20%. It's blue sky above there in terms of yield, which is catastrophic for any bond investor. Yeah, I mean, I think the interesting thing perhaps is the mining sector, because, I mean, obviously mines, I don't think have really caught up, particularly in the case of silver mines, with the new environment for silver. I think that's also true for gold. So that is really where the value is. Now, having said that, I would have thought that if we do get a market crash, the bubble bursting, then I think that they could be a source of funds for the distressed owners, if you like, of tech funds and all the rest of it, where they've got them. So they might be temporarily weak, but I take that as an opportunity to pick up mining stocks. There is another aspect to this, and that is you've got to sort of look back and think, well, we know that gold has secured the value of credit before and all the rest of it. But what actually does gold represent? Well, I mean, the answer to that is stability in prices over long periods of time. And that stability is really best illustrated by, if you like, baskets of classes of commodities. So, for example, base metals. You would expect base metals. I mean, some of them are going to go up and go down because you're going to get changes in demand and supply characteristics individually and all the rest of it. But if you take a basket over a period of time, you would expect the value of that basket measured in gold to be relatively constant. Well, I can tell you that, the IMF do run a basket which they value in dollars, but they index. But if you take that back to where gold was in the year 1900, when the Gold Act came in, securing the de facto gold exchange rate of 20.7 de jure, as it were, so that it became law, then compared with that, if you look at this basket of metals, they're roughly at 20% of where they should be. In other words, they have fallen about 80% measured in gold. Now, some of that, you would argue, is because the gold price has risen. But why has the gold price risen? The gold price has risen because the purchasing power of dollars is going down, and it's going down a lot more than the CPI or whatever other, spurious measure you might try to use. What that means is that with a collapsing dollar, not only are you going to see that basket of commodities rising against gold, but it's going to be rising even more against a dollar with a falling purchasing power. So this means that we are on the verge of a huge, huge rise, if you like, in dollar terms, of base metals. But what we see in base metals is also true of other commodities, agricultural products. I mean, the bad news in all this is that food prices by the end of this year are going to be, way above where they are. And also raw materials. I mean, all these things, basically, gold ensures that the value of a basket of these things is constant over long periods of time. There is some fluctuation, but most of the fluctuation is because of the distortions in pricing brought about by fiat currencies. That's correcting. This is what's happening. And I think in a broader sense, if you look at the derivatives, the whole of the derivatives industry, if I can call it that, it's all about creating artificial supply. Just look at silver. Look at what's happening in various other commodities. That is coming to an end because people are trying to get out of derivatives into the real stuff. The problem is that the ratio of derivatives to real stuff is like hundreds to one. So how do you cannibalize long positions hundreds of times more than the available amount of the underlying commodity? How do you churn that into the underlying commodity? Well, I mean, the only thing that can happen really is one of two things. Either the derivative concern collapses because it's valueless, because it can't be transferred into the real stuff, or the price of the real stuff has to rise to the level where conversion demand from derivatives into the real stuff is actually satisfied. And what level is that? I mean, if you look at silver, is it 100, 200, 300, 400, 500? Who knows? We don't know. So, yeah, I mean, this is going to be really interesting. I think as far as investors are concerned, they really should be thinking hard about commodities as a whole. And if they're not buying ETFs or whatever, and I'm not a great fan of ETFs, quite frankly, because I think they misrepresent a position. But you've got commodity producers, miners, whatever, which are interesting. that's something which I think you should do some research into and get the hell out of some of this stuff, which has really depended on the credit bubble to push their values higher. They're going to collapse. And I think initially, as I said, I think it could be a problem for the stuff you should be in. I mean, to go back to the great financial crisis, what we saw gold being driven down from $1,000 just before the crisis to, I think it hit a low of something like 680 before subsequently going on to, $1,200 or something in 2011. No, $1,900 in 2011. There could be that initial sell-off, if you like. But my goodness, what an opportunity then to shift into something that's going to represent commodities and is a perfect hedge to get out of fiat currency risk. You still have credit risk because it's not the same as gold. Gold is final settlement. So silver, if it is accepted, final settlement in the sense that there's no counterparty risk. If you own mines, you've got counterparty risk. You've got a management that's meant to deliver you an income and earning stream as a shareholder. But you don't even have that half the time, because how do you hold your shares? They're in certificateless form. What that means is that there is another party in between you and the company, the mining company. So the responsibility for the mining company is not to you, but it's actually to, say, the DTC, or in our case, Euroclear. And they can use your shares as collateral in a meltdown in order to save the system themselves, in other words. Okay, they still owe it to you, but what's that obligation worth? So I would say if you're going to buy mining stocks, then try and get certificates. Try and actually be direct ownership of certificates rather than relying on a counterparty in the middle who legally are owners, if you like, with an obligation to you. They're owners of those shares and they can use them for whatever they damn well want. And this is, we're looking at a scenario really which applies when things really do go wrong. You've got to protect yourself from that as well. It's not just a question of saying, well, I think this is cheap, so I'm going to buy it for whatever reason. No, you've got to look at the system and see whether the system is going to default on you as well.
It reminded me of David Roger Webb's work. And
exactly that. He made this point. I didn't get the impression that he knew quite why they were doing it. He just realized, and I think this is the important takeaway from what he was doing, that suddenly things are getting out of our control. It's getting into someone else's hands. We no longer have the relationship of actual owning shares. It's now, they're now owned by these sort of mega intermediaries, whether it's Euroclear or DTC or, whatever. He's absolutely dead right. But I can tell you that I don't think this is part of a conspiracy to deliberately defraud us of our entitlements. I think what it is there's two things. Firstly, it streamlines the whole operation in terms of share transfers and all the rest of it. That's obvious, yes. But it also does mean that legally, you no longer own the shares. You have instead an obligation from the system. And if the system fails, goodbye obligation.
Boy, it makes you think about other things in your life that you think you own and possess.
Oh, and, indeed.
Oh, my gosh.
You're going down a rabbit hole, which is something, it's rather like Alice in Wonderland. You fall down the rabbit hole and wonder where the hell you are.
Well, was it Lewis Carroll?
Absolutely, yeah.
Yeah, he was on the money with that, and it's fun. Like I was sharing with you off camera. I'm finding more and more. It's like I want to say pretty much everything. I don't want to say everything, but just a lot is just not what is portrayed. And oh my gosh, wow. Is there anything else that you'd like to share that is catching your attention, or even outside of financial markets that you feel is important?
Well, obviously, we look at the geopolitical situation. We look at Ukraine. That's I mean, that's just getting worse and worse for the Ukrainians. We're killing. It's us who's killing the Ukrainians. I mean, make no mistake about it. The West does not want to give in to Russia. Now, I think that President Trump is taking a different view on that, and good for him. I hope he is. I mean, there's a lot of propaganda that suggests that he is. Whether it's propaganda or true, we never know. But the European leaders, I mean, my God, I mean, they're not fit for purpose. They seem to want war against Russia. And, this is just nonsense. And then, of course, you got the Middle East with the Israelis, I think, getting themselves into a real twist over Iran. I mean, you got, America's naval flotillas just approaching on the whole thing. It's all looking sort of like it's going to escalate. I think it's probably threat more than escalation at this stage. But the Iranians have said quite clearly, look, if America attacks us, we'll attack Israel. And Israel basically wants to stand back and not get involved. But on the other hand, Netanyahu is going over to America to say, come on, we've got to, try and find a way out of this, I think. This escalation is not good. I don't know that it's going to go anywhere, but if it does go anywhere, the first thing that happens is that the missiles, and some of them I think are very hard to stop, will hit Tel Aviv very hard. And not only that, the Straits of Hormuz will be shut. And what price oil? I think Goldman Sachs reckon it would go to $300 a barrel. I can't endorse that, but they probably know more about it than I do. I don't think oil is overvalued, and I think it could be a trigger for a far higher value, certainly. What does that do to everything? It just sort of collapses everything. And that's something which, one wonders whether, the people who are sort of playing this game of chicken with Iran actually really understand. It's worrying. So, yeah, we think about that. We wake up in the middle of the night and think about it a bit. And then hopefully we'll go back to sleep.
That's right. And, I'll just comment as I've been on this journey. It is really fascinating, I think very much underappreciated by the general public, how the financial markets and, I'm still learning, to better understand the nuances of it. But it is interesting to see how where capital is rotating, capital flows in and out of certain areas are indicative of, events that are to come because of insiders. And I mean, even tangentially, the poly market, it being serving as a barometer pertaining to people's sentiment. It's very interesting how it's like an early indicator if you know what to look for.
Yeah, oh, absolutely. And I think the thing to bear in mind is that what we're told is all propaganda. Make up your own mind, do your own research, have an independent mind. I don't think it's ever been more important to have that approach to life than we have today.
Absolutely. Absolutely. Alasdair, how can people learn more about you and get in touch with you?
Well, I have a Substack channel, which is macleodfinance.com. And I try and explain these things in language which hopefully is not too difficult to understand. So I cover money, credit. Money is always gold in our laws, in all our common laws, despite what governments try and tell you. And credit is everything else. So you need to understand the relationships between money and credit. So it's economics, it's also geopolitics, because that is really driving so much of what we see today. And I'm glad to say we're getting a pretty good response in terms of interest. And I think, people who understand this early will survive a lot better than people who come late to the table. So that's my mission, to try and educate people.
There's certainly a lot more to be educated. That's for sure for people out there. Alasdair, always a pleasure. Thank you for your time. Be well, and we'll be in touch here before long.
Thank you very much, Christian.
Thanks for tuning in. And if you enjoyed the show, I encourage you to like, share, and follow if you found value in it. I always look forward to hearing your feedback and thoughts. And until next time, take care and be well.